Welcome to The Explainer. Today, we are diving deep into a really high-octane investment strategy, one that's designed to do one thing: beat the market. We're talking about the Nifty Alpha 50 index. But the big question is that potential reward really worth the pretty significant risk? Well, let's find out. A lot of us start our investing journey with standard index funds, right? Like ones that track the Nifty 50. And look, they're fantastic. They're a super low-cost way to get the market's return. But for a lot of people, that's just the starting line. The real question that pops up is, how do you get beyond just being average?
And that really gets us to the core challenge, the holy grail for pretty much any serious investor. How in the world do you build a portfolio that can consistently, year after year, give you returns that are better than what everyone else is getting?
Well, the traditional choices kind of put you between a rock and a hard place. On one side, you've got your passive funds. They're cheap, they're simple, and they absolutely guarantee you the market's average return. Okay, fine. On the other side, you've got these active funds with expert managers, but they're expensive, and study after study shows they often don't even beat the market after you subtract their hefty fees. This whole dilemma is exactly what opens the door for a third way. Okay, so let's get into the solution. It all comes down to this one powerful, kind of mysterious-sounding concept in finance called alpha. And trust me, really getting what alpha is the absolute key to understanding this entire strategy. So here's the most important thing to get about alpha. It is not just about getting high returns. Not at all. It's about getting high risk-adjusted returns. It's basically a way to figure out if a stock's amazing performance is because of some genuine skill or quality, or if it just got lucky by taking on a boatload of risk. And the entire idea behind the Nifty Alpha 50 index is built on this. It's this belief that you can capture this skill, this outperformance, not by relying on a human fund manager's gut feeling, but systematically, with a transparent, rules-based algorithm. So how does this algorithm, this set of rules, actually go out and find these high alpha stocks? Well, it's actually a pretty cool multi-step process that works kind of like a funnel for performance. Okay, so here's how it works. It starts really wide, looking at the 300 biggest and most traded companies. This just makes sure you can actually buy and sell them easily. Then it starts filtering. It kicks out any company that's too new or doesn't trade every day. And finally, the magic step. It calculates that all-important alpha score for every single remaining stock based on the last year. And then it just picks the top 50. That's it. A super concentrated portfolio of what the data says are the proven winners. Now, what's really fascinating is what this purely rule-based process spits out. Because the index doesn't care about diversification, it only cares about alpha. It can make these massive bets on certain sectors. I mean, look at this. By late 2025, financial services made up more than half of the entire index. That is a huge, high-conviction bet on where the market's momentum has been strongest. And when you look at the actual companies it holds, it all clicks into place. These aren't your typical, safe, big blue-chip stocks. No way. These are the companies that have shown just incredible risk-adjusted momentum. You've got BSE Limited, which was riding a huge wave in derivatives trading. You even have a comeback story like 197 Communications, whose huge price recovery gave it a massive alpha score. So for years, this strategy was an absolute superstar. It was putting up incredible numbers, making headlines. It looked like a cheat code. But then 2025 happened, and it served up a very stark, and for a lot of people, a very painful reality check. But first, let's just appreciate the long-term promise. Why did people get so excited? Well, look at this. Over the 5 years leading up to 2026, the Alpha 50 delivered a jaw-dropping 20.55% return, compounded every single year. It absolutely crushed the regular Nifty 50's 14.63%. I mean, this right here is the massive appeal of the whole thing.
But then, this happened. In the single year of 2025, the script just totally flipped. The Alpha 50 index lost almost 12% of its value. And at the same time, the broader, more stable Nifty 50 actually went up by over 10%. That is a staggering 22% difference in performance in just 1 year. Ouch. So this huge, sudden drop-off just begs the question, right? What on earth went wrong? Why did a strategy that's specifically designed to beat the market suddenly fail so spectacularly? Well, according to analysts, it was pretty much a perfect storm. 3 big things happened at once. First, the high-flying stocks in the index just got way too expensive,
and investors started moving their money into safer, bigger companies. Second, a ton of foreign money left India to go chase that massive AI boom happening overseas. And third, the blockbuster earnings growth that had been fueling this index for years finally started to slow down. And the numbers show this risk was baked in from the start. Just look at its standard deviation. That's a measure of how wild the swings are. It's high. And its beta is over 1, which basically means it's designed to amplify the market's moves. So it's like putting the market on steroids. It feels amazing on the way up, but it is incredibly painful on the way down. So, all of this brings us to the most important question of all. Who is this high-risk, high-reward, high-volatility strategy actually for? Let's be crystal clear here. This is absolutely not a core holding for most people. The right kind of investor for this can watch their investment fall by 20, 30, maybe even 40% and not panic sell. They have a really long time horizon. We're talking 5 to 7 years minimum. And most importantly, they're using this as a smaller satellite piece of their portfolio to juice returns, not as the foundation of their entire retirement plan. Now, if you're listening to all that and thinking, yep, that sounds exactly like me, well, the good news is that getting access is pretty simple and cheap. You can buy an ETF, like the one from Kodak, just like a stock on the exchange. Or if you're more of an SIP person, you can just invest in a regular index fund from places like Bundan or Kodak. So, in the end, it really all boils down to this one simple question you've got to ask yourself. The Nifty Alpha 50 offers this powerful, rule-based way to chase those market-beating returns we all dream of. But as 2025 showed us, really brutally, that chase for high alpha comes with some serious heat. The only question is, can your portfolio handle it?